Hello and welcome to Policy Watch, your packed snapshot of the week's biggest business developments, their context, relevance and policy implications. I'm Govindraj, Ethiraj. Well, inflation numbers are rising again, up to 5% in October from 4.4% in September. Now, one reason for this is rising food prices. On the other hand, industrial production, as measured in the IIP or Index of Industrial Production, has slowed down to 3.6% after hitting a 34-month high in September. Now, the worry is, could inflation rise again and thus make cost of living expensive for all of us? And on the other hand, will the economy get back on a stronger growth footing? More importantly, what needs to be done? To discuss this, I'm joined by Madan, Chief Economist of Care Ratings, and Sujan, Hajra, Chief Economist at Anand, Rathi, Securities. Gentlemen, thank you very much for joining us. Let's first try and understand what we can make out of these numbers that have been coming out. Why don't you start off, Madan?
So actually, we're looking at most of the macroeconomic numbers which are available. They provide very confusing signals. Confusing in the sense that most of the macroeconomic indicators are looking upwards. When I say upwards, they look very positive. It means inflation coming down, stable exchange rate or a better performing currency, mild growth in industry. But it doesn't give you the same kind of confidence that or enthusiasm to say that things have really turned around and we're looking upwards. So therefore, we can still say that at a conservative level, we are expecting a GDP growth of around 7.5, 7.6%, which is not really very great compared to what was last time. And there's a lot of doubt about how these GDP numbers have come about. But one quick indicator which we look at to see how overall the economy is performing is the corporate performance. And we have seen that for the fourth successive quarter, there has been pressure on sales as well as profitability, which actually gives a feeling that the major recovery which we were talking of has probably been deferred for some more time.
Okay. Sujan, inflation at 5% and industrial production slower at 3.6%. What do you take away from that?
Obviously, inflation at 5%, that means CPI inflation is 5%. The kind of market I work for, there the WPI is more relevant, which is still in deep negative. Having said that, while I agree that there is some level of confusion about the state of the economy, but major part of this confusion is coming because for the first time we are going through a deflationary phase, not only in India, globally. So if you adjust even the corporate performance for the deflationary trend, what you will see that the volume growth has not got much impacted. In fact, that's also reflected by the fact that if you see the corporate margins, be it at the operating level or at the net level, the margins remain largely unscathed. But having said that, there is a high level of skepticism about what this 7% or 7.5% growth number is suggesting us, or what the inflation numbers are suggesting us.
Okay, but inflation at this point is rising and industrial production is falling when in both cases the contrary was expected. Why is that?
Now, again, inflation, so far as inflation is concerned, we know the sharp fall was largely because of a base effect. And
we're losing out the effect of the base effect,
You are in the third successive season of crop failure. So obviously your food inflation is bound to go up. On the growth front also, what we expected earlier, that the stalled projects will get started, reform will get expedited, those haven't turned out. So what we expected and what's happening right now, at least till this point, there is a huge gulf, and the gulf is on the negative side.
Okay. Well, there seems to be some variation between rural consumer price inflation and urban consumer price inflation. Is that something that is a newer phenomenon compared to previous years, and
no,
why
I think
so?
This was always there, Govind, because when we're looking at the typical consumption basket of rural folks, it tends to be more oriented towards food. And when you're talking of urban, it's more diversified, but still there is a tendency for food items to have higher weightage. So therefore, when food prices go up, there would be a differential impact on both the series of inflation. So I think today the confusing part which we have is that do we actually say that are we in a situation where inflation is grim and moving upwards, or is it actually coming down? And I think for the first time we are seeing a situation where the WPI is showing some kind of disinflationary tendency. We have a negative number for quite a number of months, and the CPI inflation is going upwards. And the policy stance is something where we are trying to target the CPI inflation, over which monetary policy actually has little control. It has more impact on the WPI rather than the CPI. But the forward guidance which we're going to get from the Reserve Bank of India is going to be based on what happens to the CPI. So I think overall, if you say as far as inflation is concerned, I think as long as it's being caused by food items, it's a supply side factor which will get reflected in the CPI, and WPI is going to be more of a global phenomenon when we look at global commodity prices and also in terms of overall demand conditions.
So we've been talking about rising prices of pulses, and we've been in a discussion on that subject a few weeks ago. What has been the impact of that on inflation, and what does it look like it's likely to happen or likely to have in coming days?
No, in fact, I would tend to believe that when there is a supply shock for a product group like pulses, we have to live at higher prices. Because there has been quite a bit of noise and sounds made about hoarding imports. But we have seen, notwithstanding the fact that imports were reckoned as well as so-called de-hoarding did take place, the prices continue to be where they are. So the actual lesson is that as long as our supplies don't respond to the demand which is there, we will continue to face high prices. And one of the major reasons why your consumer price index is inching upwards, it will probably move towards the 5.5% mark, is essentially because of the pulses component.
Okay. If you were to look forward now, Sujan, what's the policy takeaway from this? I mean, what do we need to do if we were to bring down inflation, assuming we're seeing this as a secular sign, and similarly with industrial production?
The factor, if you split it in three parts, the first part being the food prices, there is precious little which we can do in a very short term. But say, for example, products like pulses or oil seeds, we are a net importer. So the fastest course of action is to import. But having said that, many times what happens is that the import actually takes place, but the distribution of that becomes a problem. For example, we have heard about onion coming to the ports, but it's not getting distributed. We have heard imported pulses are there, but government has given a directive that you have to sell the pulses at 100 rupees per kilo, so people are not just picking up the pulses. So these are the kind of administrative things which we can do, and we can address this part. But there will be some level of impact on the food prices. So far as the fuel prices are concerned, fuel prices have come off very, very sharply. Expecting these fuel prices will go down further, at least at this point of time, looks unlikely. So if anything, the fuel inflation from here, the base course, it will remain flat. More likely course, the fuel inflation will go up.
Okay.
So far as the manufacturing is concerned, if you see the capacity utilization in India is about 75% according to RBI survey. And if you look at globally also, the capacity utilization is pretty low. So therefore, the global cyclical, the global commodities and the manufactured products, the direction for inflation for those products will remain largely benign to downwards. But the other component, food and fuel, so therefore the divergence between CPI and WPI will continue for a considerable period of time, and I would expect the WPI inflation to be in the negative for some time, while the CPI might inch up.
Okay, so when you say inch up, so let me come to that. So which means to an Aam Aadmi, prices of what she or he consumes on a daily basis are still likely to go up.
No, absolutely, they're going to likely to go up, because I think until we wait for the next season, which will going to be the Rabi season. But again, in case the Rabi harvest turns out to be good, those specific crops which you're talking of will see moderation in prices. But if we're talking of something like your tur dal, urad dal, moong dal, these are the ones which we also import, which are primarily kharif crops. Most of the arrivals should have started from this month onwards, November, and I think even the imports which come from Burma and Canada should be coming around this point of time. There could be some kind of moderation in prices. But the way we have seen,
and if we manage the distribution more efficiently, as Sujan pointed out.
Exactly. But we assume in the normal course, the way in which we anyway import around 20% of our pulses requirements, so that would come under through the normal channels. That should be helped to moderate prices. But the important part is we have seen that whenever we've seen these kind of supply side shocks, price don't revert to the old mean. So if I was paying around say 80, 90 rupees per kilo, that kind of a norm will be distorted. Will definitely settle at a higher price. So for the Aam Aadmi, you will definitely end up paying higher prices, and hopefully because of this high base next year, we'll say that the inflation rate has come down.
Okay, right. So let me ask the other question, which is sort of the bear in the room, which is the pay commission. What is the likely impact? Because we're also trying to understand what way could inflation go in coming months.
So in terms of inflation, I think depends upon when it's implemented. To my mind, I think implementing it from January may not be feasible. So it's a call which the government will have to take, because they'll have to look at their fiscal numbers, see whether their capex is taking place, whether the revenues are being generated, this investment is going to happen or not, and then take a call whether it's going to happen this year or will go to the next year. Assuming it happens from fiscal 16-17. Now let's just look at what kind of a scenario is there. We're talking of a situation around 1 lakh crores of additional money being provided. An equivalent amount could come from the states also. Again, the timing could of course vary. So we're really talking of something like 2 lakh crores of cash which will be given to central and state government employees. This will definitely mean more purchasing power, so one would expect them to spend more at a particular point of time. And what we have seen is that every time there's a pay commission increase which comes through, the spending happens almost immediately with the kind of pent-up demand which is there.
Right.
So it will be a good thing for industry. But I'm not quite sure what will be the impact on inflation, because so far we're only talking of cost side inflation because on the food side. But this kind of negative growth which we have seen in manufactured goods inflation could get reversed, because definitely there will be demand pull pressures. To that extent, there could be some pressure on the Reserve Bank of India also.
Right. Okay, so when you say pressures the Reserve Bank India to not cut rates further?
Not to cut interest rates, because the moment you see demand side inflation picking up and you're going to have a liberal interest rate policy.
But that runs counter to the general expectation that Reserve Bank will cut rates further, at least from industry.
No, as of today, we feel that RBI should be cutting interest rates. But when I suddenly have a factor of around 2 lakh crores presumably being spent on industrial goods, in case people save it and don't spend it, then we won't have a problem. In which case the industrial revival will also take some more time. But assuming people are going to start spending this money on, say, housing or maybe on buying consumer goods and automobiles, there'll definitely be a case of an upward pressure on prices. So the RBI may have to probably slow down on lowering the interest rates.
Right. So let's park that for a moment. So what's your outlook, Sujan, if you were to look next 3 months with or without the pay commission?
See, as I told, I would expect the food inflation to inch upwards. I would expect the fuel inflation to inch upwards. Manufacturing is a call. It's slightly difficult to take, but at the margin, manufacturing might remain largely flat. So I would expect the inflation to move towards 5.5, 6 kind of trend. But I don't think that will set a trend. The moment inflation inches up to 5.5 and 6, people will draw a straight line and say it's going to 7 and then 8. I don't think that's going to happen. But from this level, the inflation will go up. But at any case, if you look at RBI's projection, RBI is talking about more of a 5.8% by January 16.
Yeah.
So
this is well within that. Yeah.
I would expect it to remain largely within that.
So you're saying that this environment that we're seeing is still broadly within the arena that RBI has defined?
Yeah,
and
what do we say RBI's comfort zone?
You agree with that?
Yeah, I fully agree with that. It's only a case of
You said people shouldn't be drawing straight lines and assuming that it's going to go rocketing.
No, I think that's what we also tend to do, because very often when the rupee also starts depreciating, we have all the experts coming and saying it's going to go up to 17 and you realize it's back to 65.
Right.
So we should not be drawing the straight line and do this kind of exponential interpretation. But definitely I would tend to think that any kind of spending on account of the pay commission would be having also some inflationary impact given the past experiences.
Right. Thank you both for joining me. We've run out of time. We're going to come back on the other side and look at what the markets are saying. A lot of confusing signals coming from there as well between asset classes. Join us then. Welcome back to Policy Watch. The stock markets have been choppy once again with substantial swings in the last week. More than the markets, gold has been heading steadily down, now at a 5-year low. For investors, this could be a tough time to decide about which asset class to invest in. More importantly, what signals are the markets giving out that policymakers and, for that matter, investors like you could take heed? Joining me to discuss this are Kunal, Bothra, Head Analyst at LKP Securities, G. Chokkalingam, Founder of Economics, and Ajay, Bagga, Chairman of OPC Asset Solutions. Gentlemen, thank you very much for joining us. So, Chokka, let me begin with you. What we are trying to understand is what are the signals that markets are giving away that we can make some sense of, whether we are investors or whether we are in the process of trying to raise money like the government is?
Certainly, the two set of factors are giving some comfort. One is a macro stability, which is evident from current account balance going down, fiscal balance going down, forex inflows are all-time high close to. And fourth, even inflation, though inched up because of the food prices, they are still under control. On industrial economic front, you have this aviation number, strong double-digit growth. You have the port volume cargo, which is growing in volume terms more than 4%. Then IIP number compared to last year, this year first half, 100 basis point higher, the cumulatively.
So you're saying though it's come down, it's higher than last year. Okay, you're taking
and
that
even
as
FDI inflows are robust at around 30%, and then margin expansion thanks to meltdown in the metal and oil prices. So there's a tremendous benefit of margin expansion. So these are all pointing towards bottoming out of the industrial economic stagnation.
Okay. So what is the markets saying from this?
See, I believe that the last 6 months have been more struggle because all the parts of the markets, different sectors of the markets, they're trying to come back together. I think in the first half of 2014, you saw strong divergence in the real estate or probably the high interest rate sectors. But now you're seeing some sort of stability coming in the IT. The pharmas are more or less consolidating. The metal sectors have picked up. So I think more or less this process of bottoming, I think would probably take at least a couple of quarters. The more important part for the next sort of rally or a bigger trend to begin would be the corporate earnings, and I think that's going to be very important key for the markets. I think till the time we don't see the health of the companies improving significantly, I think the markets may continue to be in this very volatile or choppy phase.
Right. Okay. So we're going to talk about that in a bit as well. Ajay, if you were to now pick up markets and sort of place it aside and look at now gold and other asset classes, what's really happening? I mean, how does this, or can one make sense of this?
Yeah, definitely, Govind. I think you have to look at it both with domestic factors and global factors. So global, the biggest event coming up is the Fed rate hike, or I would say the biggest non-event, because markets have discounted it. But the last 2 years, emerging markets have suffered with this expectation that Fed will hike the rates and there will be a slippage in the EM flows, or there will be outflows from the emerging markets. I think that is coming very much. December 16th, we get a Fed rate hike, and that's an event out of the way. So globally, that's the biggest macro event coming through. US economy doing well, Europe soft and bringing in more quantitative easing. Japan extremely soft in a recession with 2 quarters back to back of negative economic growth. More Abenomics easing measures expected in Japan. China, the big question mark. China, a softer China already, but the big question is, will they manage to keep a soft landing the way they do every time, or could it become a hard landing? And hard landing for China is defined as a 4% growth instead of the 6.5% that they are pointing out. So I think those are the big macro global variables. Domestic, very good thing is very low expectation of the government. Legislative process is stalled, nothing happening in parliament. So clearly the market is not discounting any good news coming out of the legislative process. Goes back to cyclical recovery. Second, how much can the government do with its governance agenda, with its ease of business agenda? So the executive reforms, how much can be done, plus where the ruling party has governments in the states, what can they do there in labor reforms and land reforms of the center state concurrent list. I think those are the few key things that the market will look. Earnings have been a disappointment, which is good, because now sell side guys last year this time were forecasting 18% growth for FY16. They've gone down to 8%, and they're carrying that pessimism onto FY17, which I think now we are going on the reverse side. We are being overly pessimistic. There's a recovery coming 6 months down the line, and I think markets will discount it faster. So in short, I see a January a strong rally in the Indian markets in January 2016 in anticipation of the recovery, which will come in another 2 quarters from now.
Ajay, okay, let me just bring in gold for a second. Chokka, why is gold heading down? Normally, gold keeps pace, or sometimes obviously shoots ahead, at least as we saw in the last few years.
See, the last 10 years, gold prices have done very well. It's substantially gone up. It's not cheap, though in the last 1 year it has come down. But the most important reason is that the global deflationary pressures. See, gold, people who want to save, they buy gold. You are not trying to make money out of buying gold, except the speculative investors. Now, there is a global deflationary sign across the world. There are so many economies are either contracting or seeing slowdown. So, in this environment, to expect that the people will, rush after gold and buy in a large quantity is not, logical. So, therefore, unless.
But is India sort of reflecting the same behavior symptoms, or?
Certainly. Okay. I mean, this 7% growth, thanks to partially, this revision of GDP calculation. Otherwise, there is a stress in the system, whole world economy. You have, for the first time, several countries, the inflation rate going close to zero, interest rate going to zero. These are all symptoms of deflationary scenario. So, therefore, it will take longer time.
In fact, if you look at the data for the last 45 odd years for gold prices from 1970 odd, generally we try and assign that when the interest rates are going to be hiked, golds and these bullion commodities may try and see some selling pressure. But the data of 45 years gives you a completely different picture. I think those two secular bull runs of 1970s and 2000, you look at the interest rate scenario hike, and then you look at the treasury prices, and you look at the gold prices. I think it tells you that the underlying fundamentals of gold is completely different. I think gold probably thrives in an environment which is more inflationary and probably more interest rate hike. So I think there could be chance that if Fed goes on to a very strong aggressive mode of probably hiking rates, say in the next 1 year.
Gold prices further come.
No, in fact, I think it could be reversed. You could probably see a spike in gold prices as well. So I think that could be.
So you're saying it's a positive correlation.
It's a positive correlation, not a negative correlation,
right.
which is generally the thesis or the theory, which we generally look at.
But what's the other point of divergence? I mean, as we try and understand Indian markets, but how are things working in the international markets, emerging markets and Indian markets? I'm talking about actual movement of stocks and stock prices.
Yeah, I think a lot has to do with what happened in India in the last 1 year and the last 6 months. I think we went way ahead of the curve as compared to the rest of the emerging markets. Even though we look at two most important parts, the economical part and the company part. From the macro scenario, I think things have improved significantly in the last 1 year. Be it the stability in terms of political scenario.
Yeah, and all the points Chokka made.
And all the points Chokka made. And now you look at the corporate parts as well. I think as you rightly said, probably the pessimism is increasing significantly, which is a good sign, because when there is extreme pessimism, there is a very good chance that you are probably going through a bottom formation. So I think this imbalance which you had in the domestic environment as compared to the underperformance or over pessimism which people are still suffering in the US markets, I think this sort of divergence will probably play out over the next 6 months. But I think once we are through that, and once the corporate earnings starts to pick in significantly, I see that we could probably roll out to a very strong multi-year uptrend as well.
Right. Ajay, is this a good time for the government to go ahead with some of the disinvestment parcels that it's looking to offer?
Well, they have not delivered much on the ground, and so the markets have become weaker. I think last year was a good time, Govind. Now they'll have to wait out. There is capacity issue in the market because foreigners are selling for various reasons and domestics are kind of holding up the market. So the absorption capacity is lower. It will be difficult to disinvest. Second, you are not getting good prices, especially on the commodity side, for example. So if Hindustan Zinc or Balco, the government had moved faster, whichever way you want to divest, whether to a strategic investor or you want to divest to the public, I think very difficult to really get good valuations for commodities right now. So difficult. We saw it with the Indian oil issue as well, where LIC had to step in and take up a huge portion of that issue, otherwise it would have devolved. So I don't think it's possible. The divestment target will not be met, Govind. That's the writing on the wall. And government should work more towards what are the measures which will strengthen the depth of the market, bring in more players into the market, force the EPFO guys to now start investing into the markets. Foreigners are holding a good 25% of your market. 48% of free float on the BSE is held by foreign institutions, and our own pension funds are still like ostriches with their heads sunk in the sand, talking of fixed income instruments only. I think those things, if they can move forward, then maybe next fiscal we can have a strong disinvestment execution. This year will be very difficult, Govind.
Right. So, Chokka, outlook for the near term, which is maybe the next couple of months, beginning January 2016 and then onwards.
I still remain very optimistic. I have given 20 to 25% return. Only two risk factors. One is the monsoon. Third time if we fail, then it will be a disastrous. And second, the global deflationary pressures. In case they keep rising, then that will be a major risk factor. Otherwise, we are set for 20 to 25% return. Market will take a positive trigger after the Fed meeting. I firmly believe the Fed will increase the rate by 25 basis to 50 basis point. That will give a good signal to the entire global equities, because that will recede the fear of global deflationary scenario.
Right.
So this is my outlook.
Right. Kunal, last word?
Yeah, I think one very important observation, I think in the last 9 months, you look at the PE of Nifty, I think, from the 9,100 top to those bottoms of 7,900 first and 8,600 top, the PE of Nifty remained in the range of 20 and 24. And this time, I think if you try and calculate the PE for this quarter, it comes to around 7,350, 7,400. So I think, the risk reward at this point of time, extremely good for, probably going long. I think if you try and see more stability in the earnings, I believe that the markets may probably find bottom somewhere close to 7,500. So I believe that the worst is probably over, and I think over the next 2 to 3 months, I think would be a very good opportunity to go long.
Right. So that's a good note to end on as always. Thank you so much for joining us. We've run out of time on Policy Watch. We'll be back next week, same time. Thanks for watching.